What up, YouTube? It's your boy Charles Enoch. You're watching Invest in Myself Recap Wednesdays, where I show you the highlights of last week's episodes and what you need to know without all the extra. So go ahead, watch until the end, because I'll let you know what subject I'll be tackling for this coming Saturday. But you already know, before we get started, your boy gotta do the YouTube thing. So my personal goal is to reach 10,000 subscribers before the end of the year. Now I know it's a crazy goal, but it's my goal, so let's make this thing happen. So if you're new to the channel, go ahead, take a little time, hit that subscribe button for me. Also go ahead, hit the like button for me, and make sure to leave a comment. I appreciate anybody that does all these things, as it does help me reach a higher audience base. So today we're going to talk about how you can leverage your HELOC to acquire multiple properties. So in my particular situation, I was able to pull $175,000 out of my primary home in a form of a HELOC and use that HELOC to pay 20% down on a property in the Kansas City, Missouri area. So today I want to give you a real example of what my numbers look like in this particular deal. Also, I'll show you how to incorporate velocity banking in my form of thinking when I'm buying these properties. So you already know I got the whiteboard in the back, so let's get down to business. Let's go. All right, so we're on the whiteboard. Let's get down to business with this example here. We're gonna have Leverage Lamar here. Leverage Lamar, we're gonna say his income is $6,000 per month. His expenses are $5,500. Cash flow is going to be $500, pretty much income minus expenses. What's left over is cash flow. His HELOC is going to be $175,000. Now, Leverage Lamar, he's going to pretty much buy properties, and these properties are realistic to the Kansas City, Missouri area in regards to what I'm pretty much looking for. 3-bedroom, 1-bathroom type of single family homes, right? So we're gonna say property is $145,000. The rehab is gonna be about $5,000. So usually I'm buying properties that don't really need that much fixing here. So I just kind of rounded it up to $5,000 to be safe in regards to a rehab. So 20% of 150, right? So the down payment is going to be $30K. Now the mortgage is going to be around $700. So right now, my mortgage is locked into 4.35%. The rental calculations in that area for a single family home is $1,200, which the cash flow is going to be $500 here. All right, so we're on the other side of the board, and let's say this was a perfect world and I can get as many rental properties with that same price and that same rehab amount. This is how to leverage and how much you feel comfortable leveraging and risking, right? So we're going to go with example one. Number one means that I'm getting one property, right? So the property is $145K, rehab is $5,000, $150,000. The down payment, 20% of 150 is going to be $30,000. Now my mortgage is going to be $700, and I can rent this out for $1,200, which means my cash flow is going to be $500. Now, I know what you're thinking. You're like, hey, Charles, what about unknown maintenance problems and expenses and everything, right? Now, with velocity banking, you know, what I'm doing is I shove all my income, even the cash flow that I'm getting from the rental property, so it'd be $6,500, onto the line of credit. Anything that I need out, I will take it out for expenses, right? So with that being said, for maintenance issues, my HELOC, remember I only put $30,000 down, and my HELOC's $175,000. $145,000, right? So I have a $145,000 emergency fund. So how I think about things, I don't use maintenance and all that in regards to what my overall cash flow is. And that's fine for people that do. I just know that my emergency fund, I can just draw out of my HELOC. So I'm not worried about particularly putting like a maintenance expense. I'm gonna use the $500 and all my income, shove it on the HELOC, whatever I need out in expenses, so anything unexpected, I'm secure with 145K. I feel comfortable. That is very low risk, right? All right, so let's say that you have very high tolerance and you like to risk it all, right? So let's say that you want 5 of those same properties in that Kansas City, Missouri area, right? So 145K times 5, 725,000. Let's say it needs 5,000 to rehab on all of them, 25,000. That's $750,000. All we got to do is put 20% down. That's $150,000 that we're going to pull out of our $175,000 HELOC, right? So if we think about it, 700 times 5, the mortgages all together total $3,500. The rent is going to be $6,000, right? And then so our cash flow is $2,500. So with this being said, we see that our HELOC, what's left on it is $25,000, and we got 5 properties. You know, it's a big, I wouldn't even want to say gamble, but it's a big investment. You are rehabbing them, so, you know, nothing should go wrong, right? But again, $25,000 on 5 properties. Me personally, I couldn't do it, but there are some people that they can make this work. $25,000 in emergency funds. I mean, you're getting $6,000 coming in. Your cash flow is $3,000, and they're able to do this, get multiple properties and maintain them, and shoving all this money into your HELOC. When something happens, again, like maintenance issues, we're gonna just take it out of the HELOC. So with my mortgages, right, it's including the property tax and the insurance rolled in it already. So just know that the mortgage is pretty much including everything but those maintenance issues, right, that you're gonna have. And again, we got the emergency fund. All right, so next week's video, I'll be going over how to pay off your loan using a line of credit. So when you use a line of credit to pay off your loan, you're pretty much converting the interest from amortized interest to simple interest. And simple interest is a lot easier to pay off. But we'll get into more detail this Saturday. So I hope you guys have a good rest of the week, and I'll see you guys this Saturday. Peace out.